Today, we're diving into a professional intelligence report that lays out a fascinating and frankly pretty airtight case for an inevitable panic in the uranium market. It argues that because of this unique mix of psychology, major supply shortages, and some pretty wild economics, the very companies that power our world with nuclear energy are on a collision course with a massive buying frenzy. This quote from an industry insider really gets to the heart of the whole thing. It's like a high-stakes game of chicken. Every single nuclear utility knows they have to secure their fuel for the future, but nobody wants to be the one to go first and push prices up. So they all wait. And this collective waiting game is what's setting the stage for the very explosion they're all trying to avoid. So, to really get how we got here and where this is all going, we're going to walk through the evidence, piece by piece. We'll start with the market's fragile backstory, then look at the current standoff, the potential triggers that could light the fuse, the absolutely shocking supply gap, why price doesn't really matter, and finally what history tells us might be just around the corner.
Okay, first things first. To understand the tension today, you have to rewind the clock. The decade after the Fukushima disaster in 2011 created this really long, low-price hangover that completely changed how utilities operate, and it planted the seeds for the incredible vulnerability we're seeing right now.
For years, a whole decade, uranium prices were just at rock bottom. So it made perfect sense for utilities to just burn through their existing stockpiles instead of locking in new long-term supply deals. It was smart, rational, short-term business. But that behavior drained their cupboards bare, leaving this huge structural hole in supply that's now becoming impossible to ignore.
And that vulnerability has now created this incredible standoff. You've got inventories at dangerous lows, and buyers and sellers are just locked in a stalemate. The problem for the buyers, time is definitely not on their side.
And here it is. This is the core of the problem. For 2 years straight, utilities have been using up way more uranium fuel than they've been buying to replace it. They are literally digging that supply deficit deeper with every single megawatt they generate.
And when you look at the numbers, it really puts it into focus. Just between 2024 and 2025, the industry is going to come up short by nearly 100 million pounds of uranium. That is a colossal amount of future energy that they still have to go out and find in a market that might not have it to sell.
And as Sprott's CEO John Ciampaglia says here, it's a total stalemate. The producers, the miners, they got crushed by low prices for years. So now they're just refusing to sign new deals at cheap prices. And the utilities? They're holding out, hoping for a bargain. The thing is, one side in this standoff absolutely has to buy the product no matter what.
So if everyone's just frozen, what could possibly break this thing open? Well, the report zeroes in on 4 very specific triggers. Any one of these could be the spark that shatters the calm and ignites an all-out buying panic.
You can think of these like a row of dominoes just waiting for a push. Imagine a big utility finally admitting it's short on fuel. That would force everyone else to scramble. Or a government starts buying up uranium for its own strategic reserve, shrinking the pie for everybody else. A major mine could have a flood or a fire, instantly wiping millions of pounds off the market. And the big one? Any major supply disruption from Kazakhstan, which produces over 40% of the world's uranium, would be a game changer overnight.
Okay, let's dive into the data, because the numbers here, they really show you the true scale of this supply deficit. It paints a pretty alarming picture of the risk these utilities are facing.
This one number right here is just staggering. By 2027, a full 70% of all the uranium that the world's nuclear reactors need to run is not yet bought. It's not under contract. This is, without a doubt, the biggest collective supply risk the nuclear industry has seen in 30 years. And to put that 70% gap into perspective, just look at this. Utilities will soon need to find around 130 million pounds of uranium every single year. But the spot market, where you buy for immediate delivery, it typically only trades about 55 million pounds in an entire year. The math just doesn't add up. There's nowhere near enough available.
So right about now, you're probably thinking, okay, but won't sky-high prices just stop them from buying? It's a fair question. But in the very strange world of nuclear fuel, the answer is a hard no, and let's get into why.
The key concept here, the one thing you really have to understand, is something called inelastic demand. It is the absolute foundation of the uranium market. All it means is that no matter how ridiculously high the price goes, the utilities have to keep buying, because the only other option is to shut down a multi-billion-dollar power plant.
And here's why that's true. The actual uranium fuel is just a tiny little sliver, maybe 3 to 5% of a nuclear plant's total operating budget. So even if the price of uranium doubles or even triples, it barely makes a dent in their overall costs. For a utility, paying way more for fuel is an annoyance. Not having fuel is a complete and total catastrophe.
So it all boils down to this. This quote says it all. For a utility's chief financial officer, the real career-ending mistake isn't overpaying for fuel. It's failing to get the fuel at any price, which forces a reactor to go dark and stop making money. When the panic buying finally starts, believe me, price will not be an object.
Now, a situation like this isn't totally new. We can actually look back to a very similar panic in the mid-2000s to get a sense of just how explosive this could be. But as you're about to see, the situation today is actually far, far more extreme.
Just look at the last big uranium cycle. The price shot up from around $20 a pound to over $136. That's almost a 600% jump in about 2 years. And what's wild is that incredible run was kicked off by conditions that were actually less severe than what the market is staring down the barrel of today.
Let's just compare them side by side. The 2007 panic was started by a flood at just one mine. Today we have multiple major producers cutting their output. Back then, the supply deficit was moderate. Today, it's the largest in 3 decades. Secondary stockpiles held by governments and others have been drained. And geopolitical risk? It's off the charts. The kindling for this fire is just so much drier this time around.
And look, the market analysts, they see what's coming. As this investment firm points out, the second that utilities are finally forced back into the market to sign those long-term contracts in a big way, the price move is going to be incredibly significant. They're already forecasting prices hitting $200 a pound by 2028.
So, when you put it all together, the evidence is pretty overwhelming. A utility buying panic really isn't a question of if, it's a question of when. The combination of years of not buying, this massive supply deficit, and the simple fact that they need this fuel at any cost, it has created a powder keg. The only things we don't know are what's going to be the final spark and just how high prices will fly when this thing finally blows. What happens when that window to buy finally slams shut?